Hey, this is Chris from Mission Capital, and in today's video, I'm going to show you how to model out a bonus accrual in your financial model. So what I have here is a blank three-statement model of a hypothetical company that has zero operations and zero cash, because I think that's the easiest way to understand the example. And in the P&L here, I have a line for bonus expense. And the way that bonuses typically work is a company will set aside or accrue an expense all year long that they know they're eventually going to pay in cash at the end of the year. And so building this accrual schedule into your model allows you to make the distinction between accrual and cash-based accounting. So let's just pretend that for this company, we're going to accrue $10,000 of a bonus expense each and every month to then pay out a $120,000 bonus in cash in December. So I'm going to put a $10,000 expense in each month. And so you can see I've got the expense, again, 10 each month, net income each month of -10. Now, your income statement likes to think on a cash basis, and so it's your job as the modeler to build a balance sheet to adjust it from what it thinks is cash to what is actually cash. So let's go down to our balance sheet now. So I have a schedule down here called the bonus accrual. And what I'm actually doing is I'm bringing that $10,000 expense into each and every month in this accrual account. You can see it's got a beginning balance, then I'm adding the expense. Later in the year, I'm going to pay it out, and then I have the ending balance of that liability. And so as the month continually goes on, you can see the liability is increasing because each and every month I'm adding $10,000 to that liability that I'm eventually going to pay. And so up on my balance sheet, you can see I'm recording that same liability here because this is linking to my bonus accrual schedule down here. And so in the cash flow statement, what's happening is as I'm recording the expense, but then adjusting my liability, the cash flow statement is becoming net zero because the net income is saying, well, my income statement thinks I spent $10,000, but my balance sheet is saying, no, that's not actually what happened. We're adding back that $10,000 each and every month. We're only going to pay it out at the end of the year so that my change in cash is actually zero all year long. So at the very end of the year, I have a formula out here in December that just says, hey, if it's month 12, then pay out the full bonus amount. So what's happening is now we're talking cash. So the $120,000 that I've accrued all year is finally coming out in cash, and it's emptying my bonus accrual account, which means it's getting rid of the liability on my balance sheet. And then you can see in the cash flow statement, now I'm actually paying out the 120 because I have 10 of expense in that final month, and the change in my balance sheet account is the remaining 110 for the full 120 to come out. So even though I have a $10,000 expense each and every month, the cash impact doesn't happen until the very end of the year when that bonus is fully paid out, 120 here. The way you do that, again, is by building this bonus accrual account where you accrue the liability each and every month, and then you link your ending balance up here to the balance sheet, which comes through here. If your cash flow statement is built correctly, it should take that net income and then reflect the changes in the balance sheet accordingly to true up the cash. And then that's how you bridge the difference between the accrual basis of accounting and when the actual cash was paid out. So I hope you found this video helpful. Thanks for watching. I'll see you in the next one.